Firstly, a bit more about Aurizon. So we're Australia's largest rail freight company. There's two parts to our business. About half of our business is based on our network infrastructure in the central Queensland area, which is a regulated monopoly infrastructure business. The other half is our haulage business, which operates around Australia. We've got about 600 locomotives, 13,000 wagons, and we haul everything from grain, copper, bauxite, alumina, coal, and iron ore. In terms of the split of that haulage revenue, about a third of it is from metallurgical coal used to produce steel. Another third is for thermal coal, and the remaining third is for non-coal commodities. We call that our bulk division. So turning then to our FY21 results, we put out our results last Monday. We were one of the few companies for FY21 to provide earnings guidance at the start of the year, and I'm pleased to say that we hit that earnings guidance expectation. We had a solid earnings result. EBIT was down 1% at $903 million, but EBITDA was up 1% to $1.482 billion. So the component parts of that, our coal haulage earnings were down 13%. The main driver of that was our volumes were down 6%, driven by COVID impacts to steel markets, in particular in Japan, but also the China coal import ban, which we saw come into place in about October, November. Secondly, our bulk haulage business, it performed really well during FY21. We had earnings up 27% to $140 million. This was mainly the impact of stronger commodity markets, but also some contract wins. And about a week ago, we announced a new 10-year haulage agreement in Western Australia, which is with CBH. For those of you who don't know CBH, they are Australia's largest grain exporter. So that will make Aurizon the biggest grain haulage provider in Western Australia. So we're really proud to be working with CBH in Western Australia, hopefully for the next 10 years and hopefully longer. In terms of our network infrastructure, it delivered strong results in FY21 despite volumes being down. And that just underscores the resilience of the business. It has various revenue protection mechanisms which kick in when volumes are down, and that happened in FY21. FY21 also saw flat net profit after tax and slightly higher free cash flow. Now that free cash flow, importantly, was $734 million, about 130% of the dividends that we paid for FY21. Speaking of dividends, and Nathan mentioned this, we declared a final dividend of 14.4 cents per share. That's up 5% on the prior year and brings our total dividends for FY21 to 28.8 cents per share. Now that's a yield of a bit more than 7%, and that's before you factor in franking, which is 70%. So that's the FY21 result. If I turn to our outlook for FY22 and beyond, we provided earnings guidance and sustaining CapEx guidance for FY22. Our guidance for FY22 for EBITDA, $1.425 billion to $1.5 billion, and sustaining CapEx of $475 million to $525 million. So that means we're guiding to a pretty similar year in FY22 to FY21. We also had an investor day in June, and at that investor day in June, we put out some longer term ambitions for our company. The main one was a doubling of our bulk business by 2030. So what we're saying to the market is we have an ambition to grow our haulage of grain, iron ore, bauxite, alumina, copper. And we think we can double the size of that business. Importantly, for those conscious around ESG, if we're successful with that ambition, that will mean our thermal coal revenue drops to less than 20% of our haulage revenue base. So that's something that I wanted to point out. I think what we showed through FY21 is we've got a really stable business, resilient cash flows, and we've got a great track record of returning capital to shareholders. In fact, over the last 6 years, we've returned over $4 billion to shareholders in the form of dividends and on-market buybacks. Now, for context, that's $4 billion from a company with a market cap of a bit over $7 billion.